Hello, dear students. Hope you're well. So we will wait for others to arrive at our conference. And to begin the next lecture with, let us check the results of a previous quiz. I will switch to Socrative. So, overall results are very good. Sorry. Yes. You have on average the results actually with this. Yeah, we have here. And let us check the your results and the correct answers. So please have a look on our picture. You're mostly 100% correct, but still there is some questions like this 4, 5, and 6 that have some wrong answers. So let us have a brief walk through this quiz. And to begin with, we have the first question about which is the following is not considered a strategy in a private debt investing. And yes, recapitalization is a strategy for exiting an investment, while direct lending and mezzanine debt is a strategy for investing. Then which is of the following forms of debt are likely to have additional features such as warrants or conversion rights? And the correct answer is C, because mezzanine debt and as well as venture debt had all these sweeteners, warrants, and other forms of rights to involve more investors and make the debt vehicles more attractive to them. Considering the embedded risk, the higher level of risk, both for the mezzanine debt and the venture debt. So these additional features providing an upside potential for the lenders should be in place. I'll fill in the blank by choosing from among the following options. What is the type of private debt expected to have the greatest excess return potential? And it is a mezzanine debt. So we can stroke out infrastructure debt because it's lowest debt with the lowest risk profile from these three, while mezzanine has an highest risk potential. So that is closely connected with the greatest excess return. Unitranche debt is somewhere between the mezzanine and infrastructure, both in the terms of the risk and the return. A collateralized loan obligation specialist is most likely to rely on a diverse risk profiles to complete deals, because it is the nature of a collateralized loan obligation to have a most diverse variety of tranches, various sweeteners for various tranches to suit the lender. So sometimes the collateralized loan obligation is also called like tailored solution, like you have a tailored suit made by your measure. That is the essence of the collateralized loan obligation.
I'm sorry, Professor, could you
Yep.
share the screen because
Oh,
we don't
so
see
I'm not
anything.
sharing. Sorry.
Yeah.
Sorry again. So just briefly.
Now it's working. Thank
Yeah,
you.
it's okay. The recapitalization is an exit strategy, not investing. The both mezzanine and venture debt have these features such as warrants, sweeteners, or conversions right. The mezzanine debt has a
Sorry,
great
but
success.
we don't hear you.
Sorry, can you hear me now?
Yes, it works.
Please check if someone cannot hear me. So now everyone is hearing me, or Yeah, good. To continue, the mezzanine debt is have the greatest success return from these three, while the infrastructure has the lowest, and unitranche is somewhere in the middle of mezzanine and infrastructure. Okay, and a collateralized loan obligation is most diverse risk profile and most diverse types of various vehicles embedded in a CLO, like various tranches with different profiles for risk and return, some additional features like conversion rights, upside potential, etc. So it's a tailored solution to suit the lender most. Private capital is a source of diversification benefit from both debt and equity. You shouldn't use this answer that because private capital is not only private equity, it can also be provided in the form of debt, and also it is rarely and virtually impossible to invest simultaneously in the same type of asset with both debt and equity, because it is exaggeration of your risks, while the common strategy for private capital investment is to have the desired and limited exposure to some asset or risk. So there is no need to have at hand both debt and equity financing in the same type of risk, asset, etc. And the first stage of financing at which venture capital fund most likely invest is the seed stage. Probably some can mistake and identify the angel investing stage, that is the stage prior to these two, but there is no typical stage when the fund comes into play. On this stage of angel investing, it's usually some friends, your relatives, or pure angel investors who is fond of your idea can invest, but not a venture capital fund. Private equity fund desiring to realize an immediate and complete cash exit from a portfolio company is most likely to pursue an IPO. No, IPO is not immediate and not complete cash exit. So you have some additional hurdles like lockup period and during which you cannot sell your shares. And it's often the case when you keep some shares with you to keep a control under the firm, and also to have the upside potential if IPO is successful and the prospects of the firm is good. And recapitalization is also not a complete cash exit, but because you're just converting your equity share to the debt and use proceeds from the dividends as a partial exit strategy. And yes, a trade sale is immediate and complete cash exit from an investment. And angel investing capital is typically provided at which stage of financing? It's clear, I think, that it's formative, the first type of all stages. And the private equity funds are most likely to use leveraged buyout. Virtually from 70 to 80% of all private equity companies that are in the industry using the leveraged buyout strategy, while others are more distant proportion of this firm. So do you have any questions regarding this quiz, regarding the answers? So probably you already have a chance to look in details and explanation for each quiz and each answer. But if you are not, or you have some questions, please raise a hand or type in the chat. Meanwhile, I will switch to the next session. Let us have a very short break for 2 minutes just to get a cup of tea or coffee, and I will back to you virtually very soon. Okay, I'm back. Hope all of you can see the screen, but if someone experienced problems with hearing me or seeing the screen, please let me know, and we'll proceed to the real estate. We'll discuss and explain investment characteristics of real estate, the strategies, subcategories, potential benefits, risk, and fee structure involved in the process of investing in a real estate. And also we'll discuss the issues regarding the calculating or returns for real estate. And to begin with, let us have an overview of the real estate market. So individuals and institutions buy real property for their own use or as an investment or both. The residential or housing market is made up of individual, single-family detached homes or multifamily attached units, which share at least one wall with another, like condominiums, townhouses, and in some countries, both in Europe, Asia, and Americas, there is also a large condominiums, or as we used the multi-apartment buildings. And they are all these apartments, real estate property in these types of real estate is owned by the residents. Commercial real estate includes primarily office buildings, retail shopping centers, and warehouses. In contrast to the owned occupied market, rental properties are leased to the tenants. A lease is a contract that conveys the use of the property from the owner, called landlord or lessor, to the tenant, lessee, for a predetermined period in exchange for compensation, that is rent. When residential real estate, be in a single or multi-units, is owned with the intention to let, lease, or rent the property in order to generate income, it is classified as commercial, that is income producing real estate. So whenever you have your flat, but you are not living in this flat or apartment and lease it, so that means that you are managing the commercial real estate property. Real estate investing is typically through an either direct or indirect ownership, that is equity investing. So we have two types of investment strategies in a real estate property, and also it can be investment in a land or building. And however, it is also includes lending, so it's a type of debt investing against real estate property. Loans secured by real estate are called mortgages. Investors can access real estate debt by lending, buying mortgages, or purchasing mortgage-backed securities, with property ultimately serving as collateral for these vehicles. The key reasons for investing in real estate include the following potential benefits: comparative long-term total returns driven by both income generation and capital appreciation. So comparative means in comparison to other types of investment, the total return, that is sum of income and appreciation of your property, sometimes it's even better than investing in stocks, bonds, etc. A multiple year lease with fixed rents for some property types, potentially providing stable income over many economic cycles, meaning you have a hedging potential against the cycle movement of markets like downturns and upturns if you're fixed your lease rent in a fixed terms. Historically, low correlations with other asset classes, and inflation hedge if leases provide regular contractual rent step-ups or can be frequently marked to market. Means if the prices are going up, the inflation is roaring, that you can adjust prices either by a item following an item in the contract or just to market. Mean if you have the overall increase in the rents on the market and you have no fixed obligations, contractual obligations with your lessee, that means you can easily move up your rent rates. A title or deed represents real estate property ownership and covers buildings and land use rights along with air, mineral, and surface rights. Titles can be purchased, leased, sold, mortgaged, or transferred together or separately in a whole or in a part. Title searches are the critical part of buyer and lender due diligence, ensuring the seller borrower own the property without any liens or other claims against the asset, such as from other owners, lenders, or investors, or from the government for unpaid duties or other legal impediments that can be imposed on these properties. And you know that the type of investing in a land as a real property called land bank is often used because you can invest in land but not constructing any property to generate an income. Just wait either for appreciation of the face value of this property or probably in a future periods when the situation will change and you have a better environment or more resources to construct something and extract income, you can use this land plot. So there's a huge variety of types of real estates and investment strategy are used. Sorry for this vague extract, but I cannot, I have no more detailed picture probably you can see, but if you cannot, I will name all the figures. It is the overall picture, so overview of the value of real estate. So residential real estate is by far the largest sector of the real estate in market in terms of market value and size. And there is a research from Savills-Ward research estimated in July 2018 that residential real estate accounted for more than 75% of global real estate values, although the average value of home is less than average value of an office building. The aggregate space required to house people is much larger than the space required to accommodate offers, use, and retail shopping. Home ownership rates are at least 80% in many of the largest countries by population, including China, India, Mexico, Japan, and Russia, and are high in other large countries such as Brazil at more than 74% and United States with at least 64% home ownership. Germany is a notable exception at approximately 52 according to the research by OECD. And the size, sorry, change. The size of the professionally managed institutional quality global real estate market increased from 9.6 trillion at the end of 2018 from 6.8 trillion in 2013, representing a compound average annual growth rate of 5.8%. It should come as no surprise that the largest and most developed countries have the highest value real estate markets, Institutional quality real estate generally consists of high quality properties owned by institutional investors and high net worth individuals. It is typically of higher value than most individuals can afford. Smaller and out-of-date properties typically do not qualify as institutional quality. Real estate is different from other asset classes. The large capital investment required, the illiquidity, the fact that no two properties are identical in terms of location, TNAT credit mix, lease term, age, and market demographics, and the necessarily fixed location of the asset. All these have important investment implications. If you can recall the four forces from the marketing discipline, like price, people, product, promotion, that in a real estate we also have this 4 P's, but here it's all P's are place. So place determines the most characteristics of any real estate property. And furthermore, price discovery in the private market is opaque. Historical prices may not reflect market conditions. Transaction costs are high, and transaction activity may be limited to certain markets. It may be difficult for small investors to establish a diversified portfolio of wholly owned properties. Private market indexes are not investable, and property typically requires professional operational management. Numerous other considerations will give investors pause between investing independently. Involvement in unfamiliar real estate markets calls for specialized knowledge of country, regional, and local market dynamics and the practices, regulations, and taxation that apply to this market. Government regulations dictate that what can be built or modified, with further complications coming from each locality zoning and permit approval process. Rules around ownership transfer and possible rent controls. Local supply and demand dynamics may override wider market strengths, complicating analysis. Many countries have limits on foreign investors with respect to property type and location, and they may require higher withholding taxes on a foreign-owned property. So that is the second set of characteristic of investment in real estate. It's illiquidity and the burdens of both the move of capital in and out to the real estate investment, and also on managing effectively this real estate property, because it can have very onerous situations in regard to the taxation system used, some legal framework, etc. Now we have an overview of real estate market. Let us discuss the possible types of and possible structure that can be applied to distinguish among the various types of investment in real estate. So we already discussed that it can be a direct ownership. The direct ownership in which the title to the property is transferred to the owner unencumbered by any financing client, such as form of mortgage. Initial purchase costs associated with direct ownership may include legal expenses, survey costs, engineering, environmental studies, and valuation fees. Ongoing maintenance and refurbishment charges are also incurred. and the property must be managed. And you can recall to the this capital budget issue from the course of investment project management, that all this course in regards to the legal setup, survey cost, engineering studies, etc., can comprise about from 10 to 15% of the total costs of the project. And you can also have a leveraged ownership when the property title is obtained through an equity purchase combined with mortgage financing. In addition, mortgage arrangement fee can apply to this situation. A mortgage is secured by the property. Any appreciation or depreciation of the property's value plus the net operating income in excess of debt servicing costs provides investor with leveraged gain or loss on the equity. Financing provided to leveraged owners is frequently in the form of standalone mortgage loans. These loans represent passive investments in which the lender expects to receive a predefined stream of payments throughout the finite life of the mortgage. The loan may become a form of property ownership if the borrower defaults. Investments may be in the form of whole loans based on specific properties, typically direct investments through private markets, or through participation in a pool of mortgages loan, typically indirect investment in real estate through publicly traded securities such as mortgage-backed securities or MBS. Real estate equity investors may use different types of pooled vehicles arranged by an intermediary. These vehicles include the following: real estate limited partnerships that offers exposure to real estate projects while preserving limited liability to the amount of your initial investment, and leaving management and liability to general partners. REITs issue shares that are typically publicly traded. REITs invest in various types of real estate and provide retail investors with access to a diversified real estate property portfolio and professional management. REITs are required to distribute most of their taxable income to their shareholders. So REITs stands for Real Estate Investment Trusts, and we will discuss REITs in detail later. Securitization of residential and commercial mortgages provide retail and institutional investors with access to a diversified portfolio of mortgages and allows the original lenders to alter their portfolio of investment. Mortgages are combined into pools and then into slices called tranches by investment banks. The tranches, each having different payment characteristics, are then sold to investors. These securities are generally not considered alternative investments, but are held as a part of the fixed income or credit portfolio. And to sum up, we can say that the real estate investing takes a variety of forms and can be best illustrated with the 4-quadrant model that arranges the quadrants by type of capital, so it's either debt or equity, and a source of capital, private or public markets. Investors can choose to own all or part of the property equity, either unlevered, that means to pay 100% of equity, or with a levered approach that relies on debt as well as equity to finance purchase. Alternatively, investors can gain exposure to real estate through debt ownership, either as a lender, originator, or as a purchaser of debt instrument issued by some third party. Banks and insurance companies are among the largest originators, owners, or mortgage debt. The residential debt market greatly exceeds commercial property. that because the total value of residential properties is larger and property owners have a greater ability to use leverage, securing loans for up to 18 and probably some of you know to 90% of the property's value or more in some cases. I know that there is still some offers on the market when you can put virtually the minimum sum of the upfront payment to enter the mortgage. In addition, home mortgages are subsidized in some markets, and probably will not experience such a good things in Russia more. So there is talks in the central bank about closing the program of subsidized finance for the mortgages. And also the mortgages enjoy government guarantees. So please use this quadrant. It's very useful for you to get an understanding or categorization for different types of real estate investment. Let us have a detailed discussion about these various types of investment. And to start with, direct real estate investing. Direct private investing involves purchasing a property and originating debt for one's own account. Ownership can be free and clear, whereby the title to the property is transferred to the owner unencumbered by any financing client, such as firm outstanding mortgages. Owners can also borrow from mortgage lender to fund the equity acquisition. Debt investors can use leverage, and initial purchase costs associated with direct ownership may include legal expenses, survey costs, engineering, environmental studies, valuation or appraisal fees. In addition, ongoing maintenance and refurbishment charges are also incurred. Additional debt closing costs are incurred when owners take out loans to fund their investment. So there's a variety of fees associated with entering real estate investment with use of mortgage vehicle. There are several benefits for owning real estate directly. One is control. Only the owner decides when to buy or sell, when and how much to spend on capital projects, subject to lease terms and regulatory requirements, of course, whom to select as a tenants based on their credit quality preference and tenant mix, and what types of lease terms to offer to its tenants. Another benefit relates to taxes. Property investors in large countries, as ranked by the size of the institutional quality real estate markets, can use non-cash property depreciation expense and interest expense with some limitations to reduce taxable income and lower their tax bills. In fact, real estate investors in a country that permits accelerated depreciation and interest expense deductions can reduce taxable income below zero in the early years of asset ownership, and losses can be carried forward to offset future income. Thus, a property investment can be cash flow positive while generating accounting losses and deferring tax payments. If the tax losses do not reverse during the life of the asset, depreciation recapture taxes can be triggered when the property is sold. Major disadvantages to investing directly include the extensive time required to manage the property, the importance of local real estate market expertise to success, and the large capital requirements. Small investors bear additional risks from portfolio concentration. The owner may choose to handle all aspects of investing in and operating the property, including property selection, asset management, property management, leasing, and administration. To address the complexity of owning and managing commercial real estate, investors hire advisors to perform any number of functions, including identifying investments, negotiating terms, performing due diligence, conducting operations, asset management, and eventual disposal of assets. Asset management focuses on maximizing property returns by deciding when and how much to invest in the property and when to sell the property. Please note here the very streamlined optimization function used in the management of real property. You have to arrive at the optimal revenue. You have to maximize the usage rate of your property and maximize the average rent for lease at the same time. So it is a multiple of two parts: usage rate and lease rate. Many investors prefer to hire advisors or managers to manage the investor's direct real estate investment in what is called a separate account, which contains only the single investor's equity or perhaps a nominal stake from the advisor to help align interests. A separate account allows the investors to control the timing and value of acquisitions and dispositions, and perhaps to make operating decisions as well. There is no commingling of capital with other investors, so it's only you separate account. Sometimes investors will form a joint ventures with other investors to access real estate. Joint ventures are especially common when one party can contribute something of value that the other lacks, such as land, capital, development expertise, debt due diligence, and entrepreneurial talent. Again, we have a close relationship to the course of investment project management when the nature of project finance suppose that you have a various proficient skills and expertise among your sponsors. Some of them can manage property efficiently. Some can construct at lower cost and according to more than technical solutions. Others can provide efficient financing tools, while the rest can deal with local authorities or provide some off-take contracts guaranteed by local authorities or the government. And the joint ventures can be structured as general partnerships or more commonly as limited liability companies. Numerous parties can pool their resources to acquire property, to develop or redevelop assets, or to lend capital. The equity stakes that investors contribute to pooled investment vehicles vary on the basis of their contribution of real assets, capital, entrepreneurial talent, and services. When structured as a limited partnership, there must be a general partner to manage the partnership and accept unlimited liability. So in this case, we follow very closely the path of private equity. So pretty the same investment vehicles and the legal structures are used. By now, let us have again a short break for 5 minutes, and then we will proceed with indirect real estate investing strategies. 5 minutes break until 7:15, please. Okay, let's proceed to indirect real estate investing. Indirect investing provides access to the underlying real estate assets through a variety of pooled investment vehicles, which can be public or private, such as limited partnerships, mutual funds, corporate shares, REITs, and ETFs. Equity rates on real estate equity, mortgage rates on real estate mortgages and mortgage-backed securities, and hybrid rates on both. Institutional investors and some high net worth investors can invest in mortgage-backed securities. Intermediaries facilitate the raising and pooling of capital and creating investable structures. Let's discuss in detail these vehicles. Mortgages. Mortgages represent passive investment in which the lender expects to receive a predefined stream of payments throughout the finite life of the mortgage. Mortgages may require full amortization or partial amortization with balloon payments due at maturity, or may be investment only. Borrowers can often choose among fixed rate, floating rate, and adjustable rate options. Some of the floating and variable rate mortgages may have limitations or caps on how much the rate can change over a given period. For example, a borrower could apply for a mortgage that carries a fixed rate for 5 years, after which the rate resets to a predetermined spread over the lender's benchmark rate, with any rate change limiting to 200 base points during the first year of the reset. Residential mortgages in developed markets usually have 15, 25, or 30-year maturities. Commercial property loans may be similarly long for long-term property owners, and other owners will take out 5, 7, or 10-year loans to correspond with the owner's anticipated holding period. Selling the property before the mortgage is due may result in a prepayment penalties for a commercial borrower. So please again note this prepayment risk that leads to the penalties for the borrower, and we will discuss the implications of this prepayment risk more thoroughly in the course of investment project management. If the borrower defaults on the loan, the lender may seek to take possession of the property. Investments may take place in the form of whole loans based on specific properties, typically by way of direct investments through private markets or through participation in a pool of mortgage loans, typically by way of indirect investment in real estate through publicly traded securities such as MBS. REITs and partnerships carry fees and administrative overhead for managing the asset embedded in their valuation. Fee structures for private REITs can be similar to those for private equity funds, with investment management fees based on either committed capital or invested capital. These fees typically range from 1% to 2% of capital per annum. Funds also charge performance-based fees, so very similar to private equity. Let's discuss private fund investing styles. Capital committed to or invested by real estate private equity funds exceeded 900 billion in the middle of year 2018. Most real estate private equity funds are structured as infinite life open-end funds, which, like mutual funds, allow investors to contribute or redeem capital throughout the life of the fund. Investor subscriptions and redemptions are commonly accepted by the general partner on a quarterly basis, and are subject to the manager's ability to acquire or sell real estate or match investors' redemptions requests with pending investor subscriptions. So just manage the cash flow stream. Open-end funds generally offer exposure to core real estate, which is characterized by well-leased, high-quality institutional real estate in the best markets. Investors expect core real estate to deliver stable returns primarily from income. Returns are typically driven by real estate beta, although managers can add value through better market selection, property management, and execution. In addition to investing in a core real estate, Core Plus strategies will also accept slightly higher risks derived from non-core markets and sectors of properties with slightly more leasing risk. Non-core properties include large sectors with different risk profiles, such as hotels and nursing homes. And on next slides, we will discuss in detail some examples of such REITs, and you can compare the performance of the REITs that invest in different sectors. Assets in the secondary and tertiary markets and such niches as student housing, self-storage, and data centers are also considered non-core. Investors seeking higher returns may also accept development, redevelopment, repositioning, and leasing risk. Finite life closed-end funds are more commonly used for alpha and beta generating value add and opportunistic investment styles. Value add investments may require modest redevelopment or upgrades, the leasing of vacant space, or repositioning of the underlying properties to earn a higher return than core properties. Opportunistic investing accepts the much higher risks of development, major redevelopment, repurposing of assets, taking on large vacancies, and speculating on significant improvement in the market conditions. Closed-end fund managers will set assets to realize the value created by management and lock in the investment's IRR. There are exceptions to the fund style, life, structure, relationships. That is, core, infinite life, open-end, or opportunistic, finite life, closed-end. On occasions, you probably can see core, closed-end, finite life funds, or open-end, infinite life, value-add funds. So there is various possible combinations of this fund style, life term, and the structure relationship can occur in the market. And we have REITs. Real estate investment trusts are preferred investment vehicles for owning income-producing real estate of both private and public sectors. The main appeal of the REIT structure is the elimination of double corporate taxation. Corporations pay taxes on income, and then the dividend distribution of after-tax earnings are subsequently taxed at the shareholders' personal tax rate. REITs can avoid corporate income taxation by distributing dividends equal to 90 to 100% of their taxable income, net rental income. So they are tax bypass entities. For example, in the United States, taxable real estate corporations can elect REIT status by meeting a number of important criteria. Among the many rules, the company must invest at least 75% of its assets in real estate, cash, or US treasuries, and derive at least 75% of its income from rents on real property or real estate mortgages. Rate and rate-like structures in most countries are similar to those of the United States. Whereas rates are popular vehicles in the United States, other countries have structures separate from corporations for rates that still permit dividend deductibility from the entity's income tax. Primary difference relate to the whether rights can be internally managed, operated, and advised, or are required to hire external managers and advisors, how much income the right may distribute, 90% or even 100%, and whether the rate is a corporation, as in the United States, or an independent structure. Rates that are self-managed and self-administered typically benefit from a better alignment of interests between management and shareholders than externally advised or managed companies. Companies that have other sources of non-qualifying income or wish to retain earnings to reinvest in the business will choose an operating company structure. Please note that the income taxes due for companies that can deduct depreciation and interest expense from operating income in calculating pre-tax income may not be high enough to accept the restrictions that comes with rate or rate-like structures. And of course, the rights are traded publicly, and the publicly traded rights address many of these advantages related to the private real estate investing. Listed rates provide investors with much greater liquidity, lower trading costs, and better transparency. Management is employed internally by the rates in most countries rather than brought as a separate organization on contract, which results in a better alignment of interest with investors. Importantly, when an investor wants to modify its real estate holding, the investor need only buy or sell rate shares on listed markets instead of buying or selling real estate directly. The rate is not forced to sell the company's underlying real estate the way open-end funds are when they are mass redemptions. Sorry. Is it okay with hello, can you hear me? Okay, sorry for this interruption. I had some problems with voice device on my PC. So we end with the rates, and let us discuss the collateralized debt obligation. And I will, along with slides, I will guide you through the history of CDOs. The evolution of CDOs dates back to a time when small banks and savings and loan associations, shortly SNLs, were experiencing disruptive change in their industry. Traditionally, SNLs have been in a business of aggregating small deposits and lending money via mortgage loans. During what was being considered a good old days, the managers of SNLs operated under the 363 rules, meaning they have borrowed money at 3%, lent money at 6%, and were on the golf course every Wednesday at 3 o'clock in the afternoon. So very lavish and easy life. Because mortgages exhibit a relatively low incidence of default, and because SNLs develop an expertise in originating and servicing these loans, the 363 rule works as long as market interest rates stayed with certain bands that keep their mortgage portfolios safe. In the 1970s, when mortgage rates rose quickly and entered a regime of high volatility, the interest rate risk embedded in the very structure of the SNL's model was exposed for its worst features. Long-duration mortgage loan portfolios generated fixed income returns that lagged behind the swiftly increasing money market rates that investors could obtain elsewhere. Because SNLs were prevented by regulation from raising deposit rates to competitive levels, depositors withdrew money, straining SNL's cash flows to the point at which deregulation finally allowed SNLs to offer more competitive rates. But these higher deposit rates caused the SNLs to officially enter into 10-5-7 rule, borrowing short-term at 10%, earning an average 5% on loans, and spiraling towards Chapter 7, that is bankruptcy chapter, so filing for bankruptcy. The days of having a financial institution hold massive mortgage loan portfolios was over in that period. The mortgage lending business became securitized with pass-through certificates, securities that allowed investors to own pro-rata position in portfolios or mortgages. These first-generation mortgage-backed securities allowed banks and SNLs to continue to originate and service mortgages while also moving them off the balance sheet. Investment banks were active intermediaries using and managing these new structures called collateralized mortgage obligations, or CMO. It's very similar to collateralized loan obligations, but here is different that the collateral is a mortgage served as collateral. Not all investors wanted to hold these mortgage pass-through securities that offered cash flows for the next 25, 30 years. Some investors wanted the short-term cash flows only, and others investors, such as pensions funds and insurance companies, were happy to invest primarily in the long-term cash flows. The key innovation of CDO's instrument is the creation of tranches that have claims to cash flows with different priorities and thus diverse cash flow and risk characteristics. So, for example, investor with high interest rate appetites could gravitate to the long-term tranches, whereas low-risk investors with shorter time horizon could gravitate to the short-term tranches. The mortgage CDO markets, that is CMOs, of the 1980s and 1990s focused on creating tranches that differ by interest rate risk only, that is, uncertain longevities of various tranches. The cash flows to the tranches contained interest rate risk, in this case, experience in the inclination of the borrowers to repay some or all of the mortgage principal. Nevertheless, the power of structured products to slice and dice the interest rate risk enabled investors to assemble risk exposure that caused a minor financial crisis caused by rising interest rates in 1994. The rising interest rates coupled with the risk exposure enabled by misuses led to fund collapses, for example, Askin Capital Management, financial institution collapses, for example, Kidder Peabody Group Incorporated, and substantial losses by government entities, most famously California, Orange County. And this all was in the 90s of the previous century. But the success of CDO mortgage products led to expansion of the concept to other asset types, in particular bond and mortgages that contain default risk. The CDOs with substantial exposures to assets with default risk were at the center of financial crisis of 2008. CDOs composed of bonds with default risk divvied up the impact of bond defaults by varying the exposure of each tranche to the losses of default in a CDO collateral pool. For example, consider a financial institution with an asset bucket of 100 million of below investment grade loans that will be moved off the balance sheet through a CDO arrangement here in the bottom of the slide. The institution has created a subsidiary known as a special purpose vehicle here in the center called SPV, whose legal status is separate from the institution and whose obligations do not directly affect the financial health of the institution. The term bankruptcy remote is typically used to describe these arrangements because the reference portfolio is held in a trust as a single purpose entity. So here, it is in this relatively simple arrangement, the SPV takes ownership of the reference portfolio of 100 million, issues a new set of securities to investors. So here we get 100 million investment, then take it on our balance and issue a set of new securities to CDO tranche investors. With the reference portfolio, so with the first portfolio serving as a collateral, and uses the money raised by the sale of tranches to compensate the financial institution for the collateral portfolio. So you receive an investment in your portfolio as collateral. You issue new securities. You sell the securities, you get the proceeds, you get the money, and you pull this money back to your original financial institution. So you're acting as a proxy, or how it called a bankruptcy remote entity in this chain of cash flow. In return for operating and management of CDOs, the CDO manager will charge a fee equal to a percentage of assets under management. So there is also an interest for this special purpose vehicle to arrange such issues. But what comes next? Here you can see the tranching scheme and the waterfall of CDO cash flow. So, for example, consider a portfolio with 100 million high-yield bonds, and we have several tranches that is comprised several tranche of 75 million with AA rating and a couple rate of 4%. Then we have a mezzanine tranche of 15 million with just near the investment rate of BBB and a higher coupon rate of 7%, and an equity tranche of 10 million with no rating and only residual claim on the proceeds of this whole collateral. And suppose we have 10 million bonds in portfolio, the weighted average yield is 8%, and if all goes well, you receive money both for the senior tranche, mezzanine tranche, and for the equity tranche with a huge upside potential, because you get all that exceeds these coupon rates if the yield for the underlying high yield bond is 8, but not 4, not 7. So all that is exceed this coupon rates will go to the equity tranche. But what about default case? If it is defaulted for 11% of the total portfolio. So you get only 98 million from your investment of 100 million. The senior tranche receive all its values, so 75 million, and 0 of the 11 millions of default assigned to the senior tranche. Now, what left? We have only 14 million left to distribute among the rest of tranches. And the mezzanine tranche, as it is senior to equity tranche, receive 14 millions for his initial investment of 15 million. So the amount of default assigned to this tranche is only 1 million, while the equity tranche is wiped out. It's received nothing from the proceeds of this portfolio because it is subordinate to the rest of the tranches. There is various types of CDOs like arbitrage CDOs, synthetic CDO, cash flow and market value CDOs, and this tailored bespoke CDO solution. So that's again the reference to the question we have in the previous session. What is the most diverse type of collateralized loan obligation? Yes, bespoke CDO is also a very diversified and tailored solution. Let us have a look also at the structure. Sorry, just a moment. Short break, please. So let us have a look at the situation on their mortgage-backed securities market in the United States in the year 2008. They have two government institutions, this company Fannie Mae and Freddie Mac, who acts as intermediaries on the mortgage market. And the typical scheme is as follows. So the borrower lend the money from some original lender as in the form of whole loans, construction loans, or commercial loans. So there is one title from borrower, so one mortgage from borrower to lender, but the lender does not want to hold this mortgage for the very period of the lease, so for 25 30 years, and he sells this mortgage to these intermediaries, that is the Fannie Mae, Freddie Mac, and other investment banks. What they do with the loans? They slice and dice these loans, meaning whenever the borrower pays a proportion, some regular payment to the lender, it comes not to the lender, but comes to the financial institutions, and they redistribute this proceeds to the other securities they created. So they have a secondary market created by them. They have new securities with different tranches, very similar to those I described in the previous slide, and sell it to the endowments, pensions funds, etc., etc. And then again, they can buy back these securities and construct the new securities for which the proceeds from the original, so the first tier securities can serve as a collateral. And then again. But what happened? Suppose you have a real estate asset here, and it is funded by property owner's equity of 25 to 13%, and the rest by the debt. So this debt comes here. You have a proportion of very high grade debt that have less percent of the new security, and the investment banks add additional tranches for the next level of tranches with lower ratings, like BBB or unrated at all. and then they have a combination as a whole security, and they ask the rating agencies to assign some rate for this security. And the methodology of creating such a security and then to assessing the default rate can be very complicated. And suppose you have more and more stages in this procedure. That leads to the situation when rating agencies probably unsuspectedly assign a higher ratings with the types of securities that held already not 60, not 70% of high grade securities, but less than 30%. So finally, you can have as much as 70% of the tranches in your security that have an ultimate collateral for them from non-investment grade high yield securities. And that was the case when the greed of investment banks, the greed of sales guys who sold the mortgages, and the blindness, unwilling or willing, of the rating agencies and regulative authorities come to the situation. It's highly publicized in the movies, books, etc. But there is very touchy examples, like someone takes an interview in this movie from the woman who is working in Las Vegas, and you can suppose what can be the possible profession to her. But he owns already 2 houses purchased using the mortgage securities, and was approached by the sales person who offers her to buy a 3rd house, again with the very interesting, very effective at the first glance mortgage security. And she even cannot really justify for her for what reason she should buy this 3rd property, 3rd house. But finally she bought. Then at some point the market crashes, like for example, this person from Las Vegas cannot serve the regular payments and defaulted on at first on the 3rd house, then in the 2nd month default on the 2nd house, and finally she defaulted on the payments for all her houses. What comes next? The intermediate bank that issued the securities relying on the proceeds from her loans did not receive again the proceeds, the not interest payments, and defaulted on his on its securities. And the proceeds from that securities was supposed to use the cash flow source for the interest payment on a higher level securities, and so on and so on and so on. So the default on very small and tiny asset can trigger a default on the initially thought as a triple A security. That was the place. And the reason for that is a highly leveraged securities in terms of the combination of securities used to construct this collateralized loans, and the quality embedded in these securities used, and the inability of rating agencies to correctly assign rating levels, ratings for such securities. So there was a cases when a triple A's default. That means it's not possible in the market, and all this lead to the high regulation of the mortgage-backed securities market. So let us have a break now for 10 minutes. We will meet at 8 and proceed with the real estate investment trust, and we'll again have a dive in the, for example, I presented here. By now, if you have some questions regarding this very complex theme of collateralized mortgage-backed securities, collateralized loan, please raise a hand, type in the chat, or ask by voice. I will happy to answer you if you have some questions. It's really not an easy topic to understand. If there is no questions right now, you can raise a hand or ask a question anytime, but we will continue at 8. So now please have a break for 10 minutes. Okay. Get back to the session. We have to discuss the real estate investment trust and investing in real estate investment trust as well. REITs are listed on stock exchanges in more than 35 countries, and their combined market capitalization exceed 1.1 trillion in the year 2016. The risk and return characteristics of REITs depend on the type of investment they make. Mortgage REITs, which invest primarily in mortgages, are similar to fixed income investment. Equity REITs, which invest primarily in commercial and residential properties and use leverage, are similar to direct equity investment in a leveraged real estate. Gross income from rents represents a relatively predictable income stream, and after servicing the debt, is a source of return for equity REITs. Although the regulations with respect to REITs vary among countries, in general, equity REITs have an obligation to distribute the majority of their income to shareholders to retain their regulatory tax advantages status. Often, at least 90% of revenue, including rent and realized capital gains, net of expenses, must be distributed in the form of dividends. The business strategy for equity REITs is simple: maximize property occupancy rates and rents in order to maximize income and dividends. Equity REITs, like other public companies, must report earnings per share based on net income as defined by General Accepted Accounting Principles, or GAAP. REITs and partnerships have fees for managing the assets embedded in the valuations. Fee structures for investment funds can be similar to those of the private equity, with investment management fees based on committed capital or investment capital, and these fees typically range from 1% to 2%. And also, funds can charge performance-based fees similar to the private equity. So very similar to the private equity. But please note that is a liquid investment. The strategy is to maximize both occupancy rate and rent rates. And also there is a huge pros if you distribute more than 90% of your earnings. And you have some differentiation between the type of investors you are. So the dividends from these REITs that are not taxed on the corporate level are taxed on the investor level. But in many jurisdictions, you can have special pension accounts, like in the United States and other companies. And these pension accounts are tax exempt, so you do not pay taxes on the corporate level. They bypass this tax issue to your personal account. But if your personal account is a pension account, you're already tax exempt, so double exempt here. It's very attractive for have such a rates in your pension account. And let's have a look at this for examples. We have the mortgage rates and equity rates. And to start with the mortgage rates, we have the Investcorp Mortgage Capital Incorporation. It operates as a real estate investment trust that primarily focuses on investing in, financing, and managing mortgage-backed securities and other mortgage-related assets. It invests in residential mortgage-backed securities and commercial mortgage-backed securities that are guaranteed by United States government agency or federally chartered corporations. The mortgage-based securities that are not issued and guaranteed by the government agency, and also they invest in a credit risk transfer securities that are not secured, and residential and commercial mortgage loans and other real estate related financing agreements. So you see the very wide variety of the instrument use. But these rates are very subject to the movements of market, and you see here the dividend yield figures for the previous year at a positive at 11%, but it was really higher 2 years ago, and they were really negative in the previous year ending 2020. So the market is can affect this sector very substantially. Also, we have this Armor residential rate that invests in residential mortgage-backed securities in the United States, and the company's securities portfolio primarily consists of United States government-sponsored entities and government National Mortgage Administration issues, or guaranteed securities backed by fixed rate, hybrid adjustable rate, and adjustable rate home loans, as well as unsecured notes and bonds issued by the government-sponsored entity. So again, slightly different strategy for such a rate. They invest in a variety of mortgage-based securities, but they tend to have a lot of them guaranteed by the government authorities. And we have more stable distribution, lower variation of dividend yield. So they pretty the same at 12% as for the years 2 years ago, the period 2 years ago, and the period 1 year ago. But we can have a look at equity REITs that invest in that provide a direct investment but with leverage real estate. MGM Growth Properties, one of the leading publicly traded real estate investment trusts, engaged in the acquisition, ownership, and leasing of large-scale destination entertainment or leisure resorts whose diverse amenities include casino gaming, hotel, convention, dining, entertainment, and real offerings. MGM Growth Properties, together with its joint venture, currently owns a portfolio of properties consisting of 12 premier destination resorts in Las Vegas and elsewhere across the United States. And you can see that the yield figures are lower for such a property, but they were substantially high in the previous periods with more favorable market situation. Note again that for the equity rights, if you invest in a non-core property, then you can have some features or problems, and we can see it very clearly with this Pebblebrook Hotel Trust that have a dividend yield for the previous year only nearly zero, and it's publicly traded real estate investment trust and the largest owner of urban and resort lifestyle hotels in the United States. So they have very focused strategy for selection of the properties to invest in. The company owns 53 hotels, totaling approximately 30,000 guest rooms. And you probably can understand the reason for such a lower figures for yield. Yes, because of the COVID-19, we have a very low market for the tourists and for very low occupancy rate for the hotels. Okay. Let us have a look on the real estate, but from the different point of view. Let's discuss the categories for real estate investment. The majority of real estate property may be classified as a commercial or residential, and residential property are defined narrowly to include only owner-occupied single residence. Residential properties owned with the intention to let, lease, or rent them are classified as commercial. Commercial properties also include office, retail, industrial, warehouse, and hospitality, that is hotels, motels, restaurants, etc. Commercial properties may also have mixed uses. Commercial properties generate returns from income, for example, rent, and capital appreciation. Several factors will affect opportunities for capital appreciation, including development strategies, market conditions, and property-specific features. So let's discuss in detail residential property. For many individuals and families, real estate investment takes the form of direct equity investment, that is ownership, in that residence with intent to occupy it. In other words, a home is purchased. Given the price of homes, most purchasers cannot pay 100% cash upfront and must borrow funds to make purchase. Most of the lenders require an equity contribution of at least 10 to 20% of the property purchase price in countries with well-developed mortgage markets. Any appreciation or depreciation in the value of the home increases or correspondingly decreases the owner's equity in a home and is magnified by mortgage leverage. In countries without well-developed mortgage markets, home buyers must save for a much longer period and may have to ask family for assistance in order to raise money enough to buy a home. Home loans may be held on originator's balance sheet or securitized and offered to the financial markets. Securitization provides indirect debt investment opportunities in residential property to other investors via securitized debt products such as residential mortgage-backed securities. Recalling this schema with Freddie Mac and Fannie Mae. The commercial real estate, commercial property has traditionally been considered an appropriate direct investment, whether through equity or debt, for institutional funds and high net worth individuals with long time horizon and limited liquidity needs. This perception was primarily the result of the complexity, size, and relative illiquidity of the investment. Direct equity investing, that is ownership, is further complicated because commercial property requires active day-to-day management. The success of the equity investment is a function of a variety of factors, including how well the property is managed, general economic and specific real estate market condition, and the extent and the terms of any debt financing. In order to provide direct debt financing, the lender or investor will conduct financial analysis to determine the borrower's creditworthiness. To ensure the property can generate sufficient cash flow to service the debt, to estimate the property's value, and to evaluate economic conditions. The estimate of the property value is critical because the size of the loan relative to the property value, or the loan-to-value ratio that determines the amount of risk held by the lender versus the borrower, can be significantly high, like 70% or even more. The borrower's equity in the property as an indicator of commitment to the success of the project, and it provides the lender with a cushion because the property is generally the sole collateral for the loan. So it's better to have the borrowers also invest as in the form of equity in this asset. And we have the rate investing. As of 2019, rates were listed already not in 35 but in 79 countries, and the market capitalization exceeded 1.6 trillion. So the huge growth for 1 year. Business we discussed in detail. It's very simple: maximize occupancy rate and the rates. And but there is some features, like many of equity rights report non-traditional measures such as net asset value or variations of gross cash flow. To better estimate company dividends paying ability. And because non-cash depreciation expense can be high for asset-intensive business. So please be aware that there is some alternation of the principles employed by the general accepted accounting principles book, but that can be applicable for the equity rates. And if we talk about the various indices that can be used to measure the performance of rates, first we should just briefly discuss them. So we have the National Council of Real Estate Investment Fiduciaries, NCREIF, that constructs a variety of appraisal-based indexes. That means that you should pass the procedure of appraisal to arrive at valuation of your property. Appraisal means you have to hire the third-party consultant, or you have to hire the auditor who can assure your in-house valuation of the property, but it's done on even if it is done on a regular basis. So the period usually no shorter than the quarter, and usually the property is assessed or valued only once per year. So we have again this problem of relevance of the current actual assessment to the situation on the market. So the historical biases for the reliance on the such assessment, and the biases regarding the problem to find the peer that was appraised recently to gauge your. And also I have the National Association of Real Estate Investment Trusts, or NAREIT, together with FTSE Group and European Public Real Estate Association, that constructs a variety of indexes based on the prices of shares of REITs that are listed and listed real estate companies. So that is a different index that is based on the market prices of rates that is listed on the stock exchanges. Let's see in detail these indexes. So there is a variety of indexes globally that are designed to measure total and component real estate returns for listed securities and non-listed investment vehicles. Listed rates indexes are straightforward in that, like other listed equity indexes, security pricing is reported by the major exchanges. Total returns are calculated assuming dividends are reinvested in the index. Importantly, listed rate index are investable when their constituent stocks are freely traded. The more frequent the shares trade, the more reliable the index. Indexes containing small capitalization, closely held, and low float real estate stocks may not be a representative of investor returns. And rates indexes in general are not necessarily representative of the entire real estate universe because of the different geographic concentrations, property types, and the asset quality of the publicly traded rate company performance. Again, recalling these 4P for the real estate property. The place determines the most of your characteristics, and also this problem of finding the good peer for you to gauge your performance. Along with this United States-based National Association for Real Estate Investment Trusts, we have the European Public Real Estate Association, or EPRA, and Asian Public Real Estate Association, EPRI, that published listed real estate company indexes for their respective regions and contribute to global indexes. Most of leading for-profit indexes providers also offer a variety of right and real estate indexes. And let us compare. As shown in this table, rates are predominant structure among listed real estate companies in the United States. That outside the United States, there is an equal balance of rates and non-rates, as represented by the FTSE EPRA and NAREIT index series. So Probably we can say that the United States market is more developed than in the rest of the world, and some other companies in which rates make up most indexes also include Japan, United Kingdom, Australia, and Singapore. In contrast with non-rate property companies, make up most of the real estate indexes are Hong Kong, Germany, and Sweden. So the variety of these percentage of indexes constructed on the basis of the non-rate and rate are different for the different regions of the world. But if we look at the historical returns, we can see that as in the table, there is some disparity among regional returns, and that supports the importance of the country-specific regional and local knowledge. So you can see that even the trends are different at the different maturities and the different time horizons for these indexes. While in North America, the returns are falling with the decrease of the time period. And Asia, in Europe, they are growing, but on the global level, they're pretty stable. So definitely the different characteristics both for Asia and Europe in respect to the North America. But if we will consider the volatility, we can see that the volatility for Europe is higher both than volatility of United States and Asia, and also as the global. While the dividend yield, given all the other aspects, are higher for the North America. So very interesting situation. Now let us discuss the issues in calculating return of the hedge funds or of the private real estate. As we mentioned, a variety of indexes measure private investment performance, and they may report on private fund performance, underlying property values, or property operating performance. Funds that track listed rate indexes make public rate performance investable, but the same instruments are not available for private indexes. Real estate values are reported by property owners, advisors, and fund managers. And many private investors do not report results, giving rise to selection bias. The private fund and property indexes vary by property selection, valuation methodology, and longevity. From my own experience, I can also vote for such a statement because, for example, really it is hard in the Russian market to find a comparable commercial real estate property, even in such a huge commercial centers like Moscow. Still, we have only 3 to 4 really comparable peers in the Moscow city, even if we consider the 30 years length period of development of various commercial centers, but really high quality, very transparent in a sense of their financial reporting, and really comparable objects here are like, if you know, the Европейский or Aviapark or Metropolis. So not so many to whom you can compare. And that's always the case in other markets too. And although in many cases private index property values are based on third-party property appraisals and therefore offer a measure of independent from owner management estimates, appraisal are nonetheless backward-looking, subject to the biases of the appraisers and likely to have a smoothed out picture of actual market volatility. Industry associations, practitioners, and academics have developed repeat sales indexes that are transaction-based rather than appraisal-based. So you construct an index on the basis of actual deals for sale and purchase of the property. When repeat sales take place, the changing property prices are measured and used to construct the index. Some indexes also suffer from a sample selection bias because the properties that sell in each period vary and may not be representative of the larger market. Although the properties that change hands are not random sample and may be biased toward those that have increased or decreased in value depending on economic conditions. The higher the number of sales, the more reliable or relevant index. For example, imagine that you have some very repetitive and frequent data from the sales in one specific region, and probably you can try to use it as a component of the index, and you can experience this problem of biasing the index volume to this very specific area. But if you will try to consider for what reason this number of sales in each given period so high for some specific area, probably it very attractive. So many market investors are willing to invest in the region. Or maybe vice versa, it's some problem area, disadvantages. And in our situation, many owners or previous investors want to sell the property at this index in this area. And if you will rely heavily on such repeated sales component in the index, where you do not investigate in detail what is the reason lies below these high numbers of sales, you can mislead the whole index, because this actual region probably are not representative to the whole or to the global or regional real estate market. So please take care when you're using a repetitive sales index. Please try to understand what drives the number of sales. And also we can say that a wide range of indexes for public stock and private real estate funds and properties are published by such organizations as Cambridge Associates, Bloomberg, FTSE, MSCI, Real Capital Analytics, Soils, and Standard & Poor's Dow Jones indices. Although investors can benefit from this variety and may well identify an index that is relevant to them, they should be aware of how these indexes are constructed and the inherent limitations that result. Investors should be aware of the real estate's apparent low volatility and low correlation with other asset classes may result from this limitation. That is especially in the feature of appraisal indexes, when you're using some model to arrive at your appraisal. And the things are that you really don't changing the model so regular and frequent as it should be. Probably you're using the same model approach for decades, and it's also smoothing the results of your appraisals. Let us check the exact methodologies that can be used for calculation and valuation. So cap rates or capitalization rates. A cap rates a percentage rate of return that is real estate investor expects or demands on a commercial property. It is formed by dividing the property's net operating income by the property total assets value. Net operating income includes rental income and direct costs, but it excludes financing costs. For example, if a 100 million property has an annual income of 9.5 million, it would have cap rate of 9.5%. A prospective buyer uses the cap rate relative to cap rates on the other properties to evaluate the property's price, and may also compare the cap rate with rates of return that are available for competing assets, such as equities and bonds. The cap rate can be viewed as being quite similar to the earnings or slash price ratio of a common stock. Equity investors use the inverse of the equity earning price ratio or PE ratio in much the same way as the cap rate is used in real estate. It's very simple. You know the net operating income, please divide it by cap rate to arrive at the valuation. So the higher the cap rate, the lower the valuation. The lower the cap rate, the higher your valuation. We also have discounted cash flow analysis, and just as traditional equity investors often perform discounted cash flow analysis to estimate the present value of expected future dividends and other cash flows, prospective real estate investors often perform discounted cash flow analysis on properties to assess the attractiveness of a property. In real estate, the discounted cash flow approach is often termed as income approach. In the case of real estate, cash flow can often be projected quite accurately. For example, when properties have substantial long-term leases. Please recall the example I present you in the course of investment project management. We have this very detailed financial model for the commercial trade centers, and there is a Excel spreadsheet that contains the terms and specific conditions for each tenant we are supposed to have in a project. That means for every tenant that will be in your shopping mall, you have to put the term of lease, the rates, the methodology by which we increase and we can change these rates, how often we can change these rates. And you know that all these data along with underlying contracts are justified by auditors when you present any kind of assessment for the auditors. That means there is a really high certainty level of the income stream for the commercial real estate property. In your maybe individual life, you can treat it as if you have a property you can lease, but you agreed with your tenant to have, for example, 20-year contract where the price, the sum of lease will be identified clearly for each period, like some base number increased by inflation plus increases by some specific percent, etc., etc., etc. And if you are the as a landlord of this property being appraised, then definitely your valuation will be very clear and certain. And we have again this comparable sale approach. Real estate is often valued using the comparable sales approach. The comparable sales approach uses recent transaction prices or similar properties to infer values on unsold properties. Appraisals tend to be performed using all three of this approach for properties with reliable income. Prospective real estate buyers often reference appraisal values in their decisions. These appraisal values in turn rely on one or more of these three methods. And as the National Organization for Real Estate Appraisals recommends, we have always to keep the final valuation or appraisal as a combination of all three methods using various weights. So it's weighted average of all these three methods, but of course with higher proportion devoted to the DCF models. Rates are composed of a portfolio of real estate properties or mortgages, and as a result, a rate security valuation depends on the entire pool's characteristics. There are two basic approaches to estimating a rate's intrinsic value. First, income-based and asset-based. The value estimates can be compared with rates observed market price. An income-based approach for rates are typically similar to the direct capitalization approach. A measure of income, which is cash flow proxy, is capitalized into value indication by using cap rate. Two common measures used are funds from operations and adjusted funds from operations. Funds from operations in its most basic form equals net income plus depreciation charges on real estate property less gains from sales of real estate property plus losses on sales of real estate property. So net proceeds from the sales. Very similar to the corporate finance methodology used to calculate any proxy of free cash flow. So please know this FFO and AFFO is other types of proxies used to calculate free cash flow. This adjustment to net income effectively exclude depreciation and the gains and the losses from the sales of a real property from FFO, and depreciation is excluded because it represents a non-cash charge and is often unrelated to changes in the value of the property. The gains and losses from sales are excluded because they're assumed to be non-recurring. AFFO adjusts the FFO for recurring capital expenditures, and it's similar to the free cash flow measure. And it's really easy to calculate AFFO. For example, you have the total capex used to construct your property, like $100 million. Then its industry average rate of 2% can be used to calculate annual recurring capital expenditures, arriving at 2 million per year. But it doesn't mean that you should spend this 2 million each year. It means that you have some special account, probably some virtual account for such needs, but you can accumulate 2% of the total costs of your capex, not cost, but of your total capital expenditures, to have some capital refurbishment, capital repairments, etc., made as you need it. So, for example, you only constructed some commercial center. Probably for the next 3 years, you will not experience any type of capital expenditure for this project, and you can virtually accommodate 6 million as in the previous example as a separate special cumulative account, and probably this means that in the fourth or fifth year, you will have enough accumulated budget to, for example, to provide new furniture, install new transportation systems like elevators or new media screens, etc. So it's just a form that represents the adjustment to a cash flow, not obligatory to be treated as expenses in each year, but to be deducted from the model for calculating the appraisal value of your property. And the cap rate and its reciprocal multiple are estimated based on a variety of factors, including market capitalization rates and current market and economic conditions, expectation for growth and the relevant measure, risks associated with rates, underlying properties, the financial leverage of the rates, and the multiples of recent transactions. The second type is an asset-based approach, calculate rates net asset value. Generally, rates net asset value is calculated as the estimated market value based on appraisals of the rate's total assets minus the value of its total liabilities. So very simple approach. First, calculate the appraised value of your assets, sum up, and then please deduct all your liabilities. And here you will arrive at the net asset value. Right shares frequently trade at prices that differ from net asset value per share. Both premiums and discounts to the net asset value are observed in the market. So that's the general approach for valuation and calculation the values of real estate. But again, there can be many types and many approaches that differ, and some specific issues, like we have definitely approach different for infrastructure objects. We can have a different approach for the land. We can have different approach for some specific types of commercial properties like hotels or restaurants, etc. So please have a 5 minutes break now, and we have only two issues to discuss. It is the risks associated with the real estate and its potential benefits. So 5 minutes break. Okay, let's finish with the 2 topics left. So what can be the aspects that discourage allocations to the private real estate? It is a illiquidity. First, private real estate properties are heterogeneous and unique, virtually eliminating the sharing of information on a specific property. And direct private real estate investment are also lumpy. Lumpiness refers to the difficulty of trading an asset in a desired way or quantity. Outside of fund or partnership investments, an investor either directly invests in an entire property or in none of it, unless claims to the property are indirect and part of a pool. So you cannot purchase a part of flat, apartment, commercial center, only if you are using some intermediate like pooled investment vehicles. And finally, direct private real estate offers income tax advantages that can be wasted by investors who do not face income taxes. Specifically, buildings can be depreciated for tax purposes in the United States and elsewhere, enabling for the deferral of income taxes. The deferral of income taxes may be viewed as an interest-free loan from a taxing authority that creates value to the recipient because of the time value of money. Although this tax advantage may be a plus for taxable investors, income tax-free investors may find that the real estate price is just such that direct real estate investment offer slightly lower expected returns. Pension funds and endowments may find that direct real estate investment contains unusable tax advantages and thus less desirable than fully taxable investment. So very simply, if you want to allocate some portion of it, pension funds and investment to the proper real estate property for the purposes of a tax benefit, probably it's better to have individual allocation of participants of pension plan to their personal accounts for the purposes, that not for the pension or endowment at all, because this institution, pension funds and endowments, are not taxed. Real estate investment risk. Real estate investments, like any investment, can fail to perform in accordance with expectations. Property values are variable in the face of national and global economic conditions, local conditions, and interest rate levels. There are risks around the ability of the fund management team to select, finance, and manage real properties, and to account for changes in the government regulation. Management of the underlying properties themselves includes handling rentals and leases, controlling expenses, directing maintenance and improvements, and ultimately disposing of the property. Expenses may increase because of the circumstances beyond management's control or be covered by insurance. Returns to both debt and equity investors in real estate depend to a large extent on the ability of the owners or their agents to successfully operate the underlying properties. And I should say that there is very specific items in the P&L of, for example, commercial centers that should be carefully managed, and if not, can be very high and even lead to a negative net income. These items like marketing efforts. It is by now the largest line item in the P&L statement of commercial real estates, commercial trading centers. But if you do not control this line carefully and in an efficient manner, it can be so great and so clearly justified by the managers, like to have a more visitors of your trading center and more purchases in your trading center. You have to invite some very prominent singer, etc., etc. But you cannot really then gauge the effect on your final financial result by that or other marketing activity, because it's really hard to understand how many purchases were made in your shopping mall after the visit of some prominent singer, but you spend the money, and finally you probably can't arrive at the desired result. So it's always a question of scrutiny about what are really good marketing efforts and what are not. And we have a very clear trend now in this area of shifting the efforts to the digital sphere. So the market efforts are really shifting to the digital sphere. It's easier and cheaper to have some advertisement campaigns that conducted in a social media, open internet, etc. And you also have a bunch of analytics already in place in the internet to gauge your performance of your marketing efforts. So that's the trend on the market. Investments in distressed properties and in property development are subject to greater risks than investments in properties that are in sound financial condition or enjoy stable operations. Property development is subject to special risks, including regulatory issues, construction delays, and cost overruns. Environmental regulation is one regulatory hurdle, as is the failure to receive zoning, occupancy, and other approvals and permits. Because the development and disposition period of such projects can be very lengthy, economic conditions may change. All these moving pieces may conspire to increase construction time or delay successful leases, which increases construction costs and reduces the level of rents relative to initial expectations. And there is also a financing risk. Long-term financing with acceptable terms simply might not be available, forcing real estate acquisitions and developments to be financed with lines of credit or other forms of temporary financing. Financing problems with one property may delay or limit further development of the owner's other project. So it's very interconnected pipeline of the project in this area. It is important to recognize that the vast majority of direct investors, private funds, and public companies pursue leverage to increase returns for their investors. Leverage magnifies the effects of both gains and losses for equity investors and increases the risks that the real estate owner or investor will be left with insufficient funds to make the investment payments or repay the debt at maturity. In that case, the lender or debt investor will receive less than the entire interest and principal balances. As loan-to-value ratio increases and interest coverage weakens, the probability of default increases. What can I say about the potential benefits of investing in real estate? Many investors find that real estate sector attractive for providing high, steady current income. It is also noted as a cash machine for the pension for its owner. Although broad stock markets gains are derived mostly from long-term capital appreciation, more than half of the returns from private core and listed real estate are derived from income. Throughout the market cycle, income is a more consistent source of return than capital appreciation, and hence it is a lower risk. The source of this consistency stems from the underlying medium. to long-term property leases. The longer the lease, the more predictable the income. And the better the credit quality of the property tenants, the more reliable the rents. So please keep in mind this term for real estate as a cash machine. So it's really predictive and reliable source of regular income. Are rates equity, debt, or something else? In line with what benefit they have? In line with our categorization above, all the assets we mentioned here, many investors view REITs as an alternative investment in the broader real estate category, and others see REITs as a fixed income or equity hybrid, adding exposure simply to the incremental yield pickup over both high-grade bonds and equities. So there is still no common understanding how to treat the benefits of REITs, but the generally it's treated as some kind of add-on, providing some additional exposure for yield pickup over the high-grade bonds. And real estate moderate correlation with other asset classes adds to its attractiveness higher. This table here lists the correlation of rates with equity and debt securities during 20 years period that ended last year. And the market capitalization of most rates is one of the smaller side, with the largest among them being notable exception. There are periods when equity rate correlation with other securities are elevated, and they are the highest during steep market downturns, such as the crisis of 2008. So nevertheless, the diversification benefit persists, and including real estate has been demonstrated to reduce portfolio risk. We can see here on the next slide whether listed real estate behaves like stocks or private real estate is a matter of ongoing debate, but we can see that the listed rates are priced continuously, whereas private real estate is appraised perhaps once a year, and there are other indications that this correlation is weak. So we have CEM benchmarking, the company that is based in Toronto, and this company performed several studies looking at the role of listed and unlisted real estate in the portfolio of defined contribution pension funds. This CEM benchmarking also concludes that real estate improves the risk return profile of funds diversified across equities, fixed income, and alternatives. We can see here the performance of each asset class over 12 years from 2005 to 2016 across 2 trillion of assets under management as gauged by the end of the 2016. The data covered 64% of European pension assets and provided a comprehensive view about how real estate performs relative to the pension fund's other assets. This table presents the asset correlations of Dutch and United Kingdom pension funds, which are among the deepest pension fund markets with real estate concentrations. This company conducted another study addressing some of the differences between listed and unlisted real estate performance by comparing the returns, volatility, correlation, and Sharpe ratios for various private real estate investing styles. Study covered more than 200 US public and private debt defined pension funds over 20 years through 2007 through 1997 2017. And unlisted real estate's correlation with listed real estate was 1.9, so very high, which supports the view that the listed rates behave more like stocks, and the short term, and more like real estate in a long term. So please again address these findings, and you can see that real estate is really a good instrument of diversification of your entire portfolio. So I suggest to have a stop here for the lecture, and we have a quiz for you, and I have a quiz for you. So what do you think? Can we launch a quiz right now, or I will leave you for homework, so we will check your results at the beginning of the next session. So what works best for you? Please let me know. Okay, have one vote for homework. Any other views? You agree for homework? Fine. Okay, let me launch a quiz, and I will also provide you with a link to the room. Here the quiz, and here the link for the room. Here you are. So I also send this link and the slides for the today's lecture in email. Do you have any other issues to discuss regarding the material, the content, any other questions? Please let me know. Good, you are entering. Yeah, right. So we will have it for homework. So I will keep it open until our next meeting next Wednesday. And I'd like to thank you for your time. Yes, I will send the slide and the link to the room for the quiz in email. So again, thank you for your time. Have a good evening, have a rest, and goodbye.